Joining us now for more on the markets, Jon Mackay. He heads in related to bones? You're not related to it. No, okay.
Not related, but you pronounced it correctly.
That's
Thank
good,
you,
because it looks like, it doesn't look like, well, it looks like what it is. It's Mackay. He heads an investment strategy team at Schroders, where he serves as the head of platforms for the U.S. client group. I think you're not ready to, I guess you're not ready to jump up and down with excitement, but you don't think we're necessarily set up for a big decline, although 5 or 6 Fed cuts, the market might have gotten a little too optimistic on that.
Yeah, I think that's right. I think the market, well, let me back up a little bit. The market's been more right than the Fed, right? The Fed was late to hike rates. We think the Fed will be late to cut rates. And I think that's where the mismatch is in the market right now. Optimism around 5 to 6 cuts this year. We think maybe they get 3. And if you get more than that, something's gone wrong. You have stress in the markets, something comes out of left field that could cause increased slowing in the economy, and the Fed would cut more in that scenario. And I just can't see stocks rallying in that environment. So I know we're all poised waiting for the CPI data tomorrow. I don't think it's going to be that exciting, right? Maybe in line with expectations, maybe slightly better in terms of the downside. But the pace of decline in inflation is going to slow dramatically this year, relative to what we saw last year. And I don't think that's a good thing for markets.
With the political backdrop, will there really be anything other than that is as exciting as what we've seen in recent years? Jay Powell, I mean, everybody, if his eyebrow twitched, we thought it meant something. 4%, no, it's 5%, no, it's going to be below. All those things could become more stable, and we might just be agonizing over what happens in this election.
I hope we're not agonizing over it. We will eventually, but probably too much to hope for. I think that will really start to take hold in the second half of this year as we get closer to Election Day, and there's more certainty. We're never 100% certain, but we have some idea of who the leading candidate is and what might be the result of that election. But I do think the first half of this year is going to be epitomized by a lot of continued uncertainty around when do they cut, when's the first cut, is it March, is it June, is it July, how quickly do they cut from there?
You said nothing about hike. You said first cut.
I would be shocked if they hike this year.
How about a recession? You don't think a recession, which is first time in history they've successfully done this, isn't it?
Look, we all talk about a soft landing right before we go into a recession, right? And I think the difference this time around is if we go into a recession, it might be a shoulder shrug, right? Relative to what we've experienced. Obviously, the pandemic was an anomaly, but what we experienced in 2008, 2009, and what we experienced in 2001. A slowdown down to 1% puts you awfully close to tripping into a recession. But I don't think there's much difference there. Negative 1%, positive 1%. Yes, it means something to GDP growth and consumers, but it's not going to sort of send the markets into a tailspin.
All right. So is 20 times earnings
too
expensive?
Much?
And that's
where we
are.
Yeah. But it's skewed by the Magnificent Seven. And so I think what we'll see this year is a broadening out of participation in the market. The equal weighted index doesn't trade at 20 times. It trades at sort of 16 times, right? So that's the rest of the stocks. That's 500 stocks equally weighted versus, skewed by 30 to 40% of the S&P 500 in 7 stocks.
Earnings have to grow this year to support where valuations are right now?
I think so.
How much will they grow?
So the expectations are for 11%. I think that's way too optimistic. Coming into fourth quarter earnings this year, you saw analysts cut expectations quite a bit, I think around 6 or 7%. So the bar has been set really, really low. We're really interested to see what companies say about their expectations for growth this year. I expect a lot of caution. It's not going away given the amount of uncertainty we have in the market. But I'd be very surprised if we got 11% growth this year.
Does that slow it down, though, if you have earnings season and companies are cautious and it doesn't match up with that? Is that kind of where there's the rubber meets the road and markets reassess?
No, because I think companies will beat the estimates. Right, the bar is so low, it's almost on the floor that it won't be hard for them to surprise to the upside. But I think what will happen is analysts will start cutting their out quarters estimates, and you'll get that 11%, moving down into the mid-single digits. I don't think that's a one-day catalyst. All right, we've got the information we needed. Now we can sell stocks. I think it's probably, at least for the time being, more related to what the Fed does and what information can we glean from economic data to make a decision on whether we should buy more or start taking risk off the table.